Hello investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. We certainly had an interesting week this week, and as of yesterday, as we were coming into the close, all of our price targets were hit at that point, and there was only one that had not yet hit, and that was IWM. I'll get to that in a moment, but as of the close today, all targets are hit. And if you're following along for the very first time, understand that these lines that I draw down here, I call those zip lines, and they're basically my forecast from the previous week, and I leave those on so we can see how the forecast worked out. And again, as you can see, last Friday I said we would move up Monday, possibly Tuesday, and then move lower, with my price target being right there at the end of that line. And what happened? We did just that. Now, I don't believe there is anyone else out there giving two-part forecasts where they're forecasting up and down. We had one comment come into the box on YouTube here saying that, well, if you're picking two targets, how can you be wrong? Well, you can only hit on one and not hit the other. And so there is more of a risk to do a two-part forecast, but it really turns out to be very good for option traders especially. And so let's look at what we could see for next week. Now, again, as we've hit this target, I'm going to erase all those lines just like that and redraw what I think we could see for next week. Now, let's take this one step at a time, and then I'll draw my line. If you're following my trading checklist, and whether you have a copy of this or not, I'll go in the order at which we look at these technical signals. We first look at the candle, and that candle right there is known as a bullish hammer candle. Basically a small-bodied candle. The Japanese labeled it the way they saw it. It's a small-bodied handle with a long shadow underneath, so it looks almost like a wooden mallet. Again, they called it like they saw it. So that tends to show up at the bottom of downward legs. You could even see back here, there was a hammer pattern, and what happened the days after it followed was an upward move. And so we have one right now, and that leads me to believe that Monday and Tuesday, maybe even into Wednesday. I know this sounds crazy with all the selling action that we had this week, but we actually could see a rally for the next 3 days. And I say, why would you say that? Because my eyes are focused on this bounce here. Watch what I do. I have a technique where I tell people to look to the left here as we draw to the right. And to really emphasize this, I'm going to take these 3 days here, and I'm going to draw the angle at which the price rallied and the duration over 3 days, because I'm talking about possibly Monday, Tuesday, and Wednesday. Now I'm going to duplicate that drawing and just simply drag it on down right there. Look at that. See how easy that is? Now notice what happens here when we drop that line in that fashion. As the price of the market is moving lower, this moving average is being drawn lower. So by Monday, Tuesday, and Wednesday, we might have this moving average moving right to that point. And if you look back in the past, the moving average has acted as resistance here and even here. So I think as we rally up in an ABC pattern of sorts, we will most likely see resistance at that moving average. Now on this one, I'm not going to make a two-part forecast, because we have to see whether or not we get a pullback from that moving average. If we do, as I told many of our members here in Dallas who have attended the RebelCon 2022, I said, if we pull back from that level, we're probably going to make a move to take out the June lows and fasten your seatbelt. So I think next week we'll start to see some pivot. We'll watch the volume start to drop and move from there. So following along with my trading checklist, again, we have a bullish candle known as a hammer. We have an increase in volume here, but look at the number of red candles that we have. So volume plays an important role. We have 4 red candles in a row that's known as a stale red light. We're overdue for a green. Now we also have a wide divergence from the price and the moving average. It's known as the rubber band effect. That's on our trading checklist. We have a gap above the market here, and we have another gap above the market here. We even have another gap here. But while I don't believe these gaps will fill, there is a great chance that this gap that was left today will most likely fill. And of course, that one will fill first, and then we'll have to see where the market goes from there. Now, going down to the oscillators, you can see something very interesting in that even though we had a big down day, the stochastics is starting to hinge. See that little change in angle? That's bullish. It's oversold and hinging, while the CCI down here is oversold and on the third lowest low for the year, and that is bullish. So again, I'm maintaining that target right there, and let me give you that exact number so our scorekeepers out there can keep track of that, and we'll report on that next week. So the upside target for the diamonds, 307.46. Now with that, let's take a look at IWM. Remember, I said as of yesterday, we had not hit that target, which was this green line, this dotted green line here. Remember, yesterday we were still away from that. We had a long way to go. But look how incredible these charts are. You know, this isn't any kind of a sixth sense for, measuring price action. I certainly am not clairvoyant. I believe me, ask my wife that. But we have price action that tends to duplicate. And that's why candle charts are so valuable, because over 200 years ago, the Japanese rice traders created these, and they didn't have computers, and they were very accurate then. If candle charts were not accurate now, they would not have survived over 200 years. They must have value for traders and investors. Otherwise, they would not exist. And week after week, if you go back, you could go back 2, 3 years, 5 years, it doesn't matter. Go back to all the recordings I've done over the years. If you're brave enough to go out there and put a scorecard together and check the percentage of accuracy, you're going to see that there's a very high percentage of accuracy when using charts like this. So now that we've hit this downside target, remember we had an upside target up here, said we would move up to 181.11. We moved up to that pivot point, came right back down, and within 3 days moved right down to that low 168.33. And guess what? Let me erase these lines as I'm explaining. We have another what? Hammer pattern. The volume is increasing on the way down, so this could be a little interesting, because in this one, in IWM, I may have to do a two-parter. On Monday, maybe Monday morning, but maybe even by the end of the close on Monday, we could see a little bit lower price and maybe even another hammer pattern. So I'm going to go just a tad lower, and then I'm going to move up later in the week to fill this gap. So again, slight downside at 164.24, then a pivot, and then right back up to 170.152. Here's another forecast that I'm going to make. I don't know if it'll show up next week because I'm drawing in red, but I do believe that on Monday we're going to have a drop in volume right there. Now I'm going to give you some geopolitical news towards the end that might affect that scenario coming into Monday, but I think that technicals are very clear that at this point the markets are oversold. Again, going to the trading checklist, hammer pattern bullish. We have a long stretch of red. That's bullish, but we're waiting for the drop in volume, which would be bullish. Look at the hinge on the stochastics, starting to move up. Look at the record low here for the year on the CCI. That is bullish. So all the oscillators and indicators are supporting the idea that we could go a little bit lower, a tad lower, and then start to move up. Let's take a look at SPY. This is getting really fun, isn't it? Well, there we go. We not only hit the target, but we blew away the target on the downside. Look, there's another two-part forecast from last week. I said we'd go up to 388.78 and then drop to fill this gap. This is the gap that I was referring to. There's an open gap. I made a comment, I think it was on IWM or one of the other ones, that I thought it was a gap but had missed or overlapped by a couple of pennies. So technically those gaps that I referred to last week were not filled. But this is a clear gap that was filled. And we have that hammer pattern. Again, we're waiting for a drop in volume here. We have gaps above the market here. We have another gap above the market that act as price magnets. We have another gap. I do not think these gaps above here will fill anytime soon, so keep that in mind. My gap fill rules are 80-20. 80% of the time gaps fill. And then once they fill, 80% chance that will reverse. So after this gap fills, we'll have to see if it turns back down from that moving average. Again, something that we have to be more or less wait and see on that one, right? So that is the spiders. Let me erase all these lines, redraw for you once again. That hammer pattern is very clear. That is a textbook hammer pattern. I'm not going to go down with this one because that that is so clear, and the oscillators are really backing up. We have more buy signals than sell signals. But because this is the spiders, and I'll talk a little bit about the VIX, I think the spiders are going to move right back up to a target of 376.54. 376.54. We're talking about 9 points to the upside here, which could be fairly significant for those that are taking short-term long positions in the option markets. Congratulations, option traders, by the way. I took a little risk when I was on stage here down in Dallas, and I asked all of those who were subscribed to my option Oracle service to raise their hand. And then I said, out of those who have their hands raised, how many of you are making money consistently throughout the year? Not a single hand went down. So all of our members who are subscribed to making money and making good money on the way down, please understand it's not an income claim. Those are just statistics that can be backed up by facts. And if anyone is out there in the comments section and you are coming out of Dallas, feel free to post your testimonial and share that information with people so we could duplicate this success. So the upside target again on SPY is 376.54. Let's take a look. I'm going to hop to the VIX right here and look what happened. Lo and behold, we went lower. Like I said, right here, we bottomed out, hit that target on Wednesday. We proceeded to go up, hit the target here, closed above the target here, and look at these oscillators. They're still moving up. However, remember, for the most part, the VIX is inversely related to what? The S&P, or in this case, we're looking at the SPY. And so if I am bearish on the VIX, which I do believe we're going to start to pull back to this moving average, that would most likely result in a higher S&P. So I'm just going with a downside target on the VIX right now, short-term downside target, 26.68. By the way, I use this as a leading indicator. I keep it on my watch list. I look at it every single day, and I do suggest and advise that our members keep the VIX on their watch list and constantly look at it. All right, so we looked at the Dow, the spiders, the VIX, the IWM. What's left? Well, we got the Qs. Here we go. All right, the Qs. Check it out. We've got an upside target here from last week, was hit on Wednesday, came right back down, and actually on the same day on Wednesday, we went up to the upside target and came down and hit the downside target in the same day. But then we continued lower. Again, same story, hammer pattern. We don't have a drop in volume, but again, I think we might see it on Monday. Oscillators starting to hinge up. CCI down here is oversold, gaps above the market, you name it. We got it on the chart. But I want to back out on this chart and show you one more thing. If I take a look at the previous support level, which is right here at these June lows, this is what we have to keep our eyes on right there, folks. Because while I do think that we could rally for 3 days next week, I'm not changing my stance, so to speak, with regard to the positions. I'm still maintaining bearish positions. I just think we could see a little bit of a short covering rally into early next week, and then I think the sellers are going to come right back in. This June low is a big deal. If we break out below that June low, that support level turns to resistance. And now we are well on our way into the down leg of phase 2 of the bear market that I've described. Remember, there's 3 phases of a bear market. Actually, I'm going to do this on a monthly chart so you can get the idea. I'll go back and look at the Dow Jones Industrial Average on the monthly to give you the picture on this. I know this video is going maybe a little bit longer than I normally do, but I think it's important to keep an eye on what's happening here. That's a 100-year chart of the Dow. As I zoom in, let me draw for you what the 3 phases are. We just ended phase 1. What is phase 1? We come down, we did a bounce, and then a pivot down from that moving average. There's phase 1. Phase 2, which we're beginning, is exactly like phase 1. It's that same pattern. We move lower, we bounce, and pivot. See there? It's identical. Phase 3 is just like the previous 2, except one difference is that phase 3 is where we generally see capitulation. That's when you have a bigger, longer, meaner, badder downward leg, possibly a bounce, and that could result in the capitulation of the market. So when you put 1, 2, and 3 together, what do you got? There it is. There's the 3 phases of a bear market according to Dow theory. It looks just like that. Here's phase 1, the bounce, the pivot. We are right here, right now. So it's getting very, very interesting for investors, traders, money managers, and even those who are on these financial programs trying to defend a long position. I know there's a lot of change in opinion, not necessarily capitulation in their bullish stance, but there's a lot more questions popping up this week than ever before. All right, so let's go to the cues again, and you can see that if we are looking at a monthly chart, I want to point one other thing out. In the crash of 2000, this is why it's so important to learn how to make money on the way down. On the crash of 2000, which began right here, the downward legs, those investors that held on and bought more and held on, for the tech sector, it took this long for them to get back to break even. It took 14 years for them to get back up to break even. Now, I don't know about you. I'm too old to be waiting 14 years to get back to break even. So I'm pursuing profits on the way down. Then I'll switch to positions up when the market starts turning back up, and we'll do the same thing, but in reverse, and taking bullish positions. You follow? Now, looking at the daily chart on this, look at that. Same exact thing. We got the June lows, we got the hammer pattern, we got these oversold oscillators, gaps above the market. What do I expect next week? Monday, Tuesday, and Wednesday. There you go. We got two gaps. We gap down on Thursday, gap down again on Friday. I'm looking for those gaps to fill or come close to filling at 282.14. One other thing before I go to the geopolitical events here, I want you to see the 52-week high, 52-week low list. Folks, I've never, ever in my career of 40 years have ever seen anything so dramatic. Looking at the New York Stock Exchange, we had 8 stocks hit a 52-week high. Check this out. 1,107 hit 52-week lows. Now, I leave the link to this website in the description box below. Feel free to look at it, copy it, bookmark it, do whatever. I reference this high-low list 3 times a day. This morning on the New York Stock Exchange, we only had 2, and there wasn't as a severe 52-week low number down here. We were about 300, maybe 360 right after the opening. And that's more, almost tripled on the downside. Again, that's very bearish, but the candle's telling us a possible bounce. Right now, look at the NASDAQ right here. We had 26 highs, and check that out, 1,248 lows. Again, I've never seen such a dramatic difference in the breadth of the market. All right, now let's talk a little bit about what's happening around the world. If you notice, I keep talking about keeping your eyes on China, keeping your eyes on China. Please continue to do that. I'm not telling you to ignore Russia by any stretch of the imagination here, but keep your eyes on China. Right now, I'm going to explain to you something. There is a referendum taking place starting today, going throughout the weekend, and these states are going to decide whether or not they want to be included in the Russian Federation. That may rock the boat, so to speak. I don't know how that's going to change Russia's stance on distributing energy, natural gas, oil, and such. But keep an eye on what's happening here. There might be some surprises. I cannot even begin to forecast what's going to happen there. I'm not going there, but keep an eye on that. Now, what I notice is that China is doing nothing to express an opinion on what's happening with the referendum. In fact, there's a reason for that. You got Xi Jinping and you have Putin and you have India all coming together in partners to create the Shanghai Cooperation Organization, which, by the way, represents 30% of the world's GDP just in those 3 countries. What does that do? It goes head to head and competes with the New World Order. They're not putting up with the New World Order or the initiative or anything that has to do with green energy. They're creating a parallel universe. That puts them in a place of extreme power, and we have to acknowledge that. Hence the reason why China is not committing to anything good or bad about what's happening in Russia. They're not rocking the boat in their relationship. Here's what I'm talking about right here. Look at that. 30% of the global GDP in this one organization. Now, this isn't something that just popped up recently. This has been in the works for a long time. And that leads me to what this is going to do to the U.S. You see, the rise in the dollar right now is creating extreme inflation around the world to those countries who buy their oil in U.S. dollars. It's called the petrodollar. So there is a risk of the petrodollar going bye-bye. There could be a complete collapse of the petrodollar. If that happens, we Americans will see extreme inflation. The rest of the world will see a drop in that. But again, something to pay very close attention to. Right now, China imports oil from Russia at record levels, right? So they're buying their oil not in petrodollars. They're buying their oil in rubles, which is backed by gold. So in essence, Russia is exchanging their oil for gold. Look at it that way. So they're building their gold supply, which backs their currency, which changes the landscape of the world economy quite dramatically. In fact, this inflation problem that we're running into and how the Fed is trying to increase rates is only going to accelerate the inflationary problem because they're not getting ahead of that curve. Look what's happening in Argentina. Argentina has 100% inflation. Their interest rates are at 75%. They're still not ahead of the curve. It's runaway hyperinflation. It's destroying their economy. See? Whether or not you believe it, this could absolutely collapse our economy and any currency that's connected to the global fiat currency system. So this is a shift that could change the landscape forever and something that is unprecedented. And that's why I keep telling people, keep your periscope up, look around what's happening, keep your eyes on China, look around the world, turn off the news, please. Turn off the news. Don't let that garbage come into your mind. Look at the facts and keep your eye on the charts and then position yourself according to what you're seeing on the charts. This is something that is also a great concern for me, especially. I'm very concerned about this. You're going to hear a lot of chatter and even a sales pitch, perhaps, about why the central bank digital currency is going to be so good. They're going to sell you the benefits. Oh, convenience, transfer of money, there's no delays, trading will be immediate in clearing of option trades and stock trades. There's no T+1, T+2, none of that. It's going to be extreme. And here's what happens. If the world, I'm just giving you a scenario, I don't think this is going to happen, but if the world were to go to a central bank digital currency, eventually they'll convert that to a global digital currency, and you could say goodbye to your financial sovereignty. Heard something very interesting from one of our members this morning with regard to green energy. We were talking about Tesla. Let me put Tesla in here. I did not know this. Gentleman lives in California, goes to charge his Tesla car. The car gives him a reading. You are unable to charge your car at this time until after 9 p.m. Imagine that. Isn't that something? How many of you knew that? Raise your hand. No, I can't see it. But put a comment in there. How many of you understand the significance and the reasons why they're pushing green energy? Why are they trying to get you to buy an electric vehicle and drive that? Why are they trying to get you off fossil fuels? Why are they trying to switch you to a digital currency? Why is there a food supply problem right now? Why? Because if these global leaders can control food, they can control the fuel, and they control the finances of the world. They literally control the world. It's a power grab. See, folks, we are at war, and please don't misunderstand me, right? This has nothing to do with Republican versus Democrat and what's happening. They are actually trying to divide us, to overpower us, and by controlling the three F's, they control you. Remember I said, you go to digital currency, they're going to know if you buy a pack of gum in the local Dollar General. They're going to know, what movie theater you visited eventually, and how many tickets you bought to go eat the popcorn with your friends. And this is about global domination. Now, why do I believe it's not going to succeed? Because I think more than half the population, I'm talking way more than half the population, are not going to have it. So if they try to push a digital currency, that will add credibility to Bitcoin because it is decentralized. Why do you think Bitcoin has been going down for so long? Because the Fed prints money, they take that money and go attack the direct competition that will compete against the central bank global currency. Bitcoin, gold, silver, and the like. Right? Now talking about silver, let me just show you a little something here. I often tell people what I'm doing with my silver position, how I'm trading it. And right here on this red candle, after the silver market gapped up, I sold 15% of my position. No more, no less. I just sold 15% of my position. Today, just after the opening, mere minutes after the opening, I had a buy order down here to buy all of that silver back on the gap fill point. So now I have a new long position that is greater than what I left behind on the gap up. So I took the dollars here from the sale of that 15%, and I was able to buy more shares than what I had sold previously to parlay the position. Eventually, I think silver, gold, and a lot of the other precious metals are going to go up when we see the implosion of the dollar. And I think there's great opportunity here. Now, again, this isn't me telling you, oh, sell everything else and go buy silver. I think even if you go to a company like Provident Metals and go buy a few silver rounds, coins, and do that. Even you youngsters out there who might be listening to this report, maybe you're in high school or college and you just have a little bit of money. Put a little bit of money aside, buy silver, and keep accumulating that over time, and you'll have a cost basis that's a lot lower as you dollar cost average down in the position. You see? So I'm very excited, especially for all of you and what you're doing for this channel. We're now regularly hitting 10,000 views, a little bit more. We're even up 10% of the previous week last week. We're up 10% in viewership, and that's all because you are liking the channel. You hit that little like button, right? You think that's a little silly thing to do, but that really helps us grow that channel and get the word out. You comment. I've seen lots of comments. And you're also sharing. I've met at least a handful of people who are sharing with investment clubs, co-workers, family members. That is all because of you that we're growing. And I ask you to remain in this position of being an ambassador to the technical analysis, because you're helping more people than you might expect. Because if we're showing people how to read the signals up, down, and sideways, it's going to help them protect against downside movement, learn how to manage risk, and then learn how to follow the trend so they can make money when the price shifts. So that's it. I'm going out to the rest of the crew. I know this is going out a little bit later than usual. I'm in Central Time. I'm going to get this recording out and wish you the greatest of great weekends. You have a good one, folks. So long.